and the floor is yours.
Perfect. Thank you so much. I appreciate it. Thanks, Mike. I'm on my phone, so let me know if it gets a little here. Let me plug it in if you can't hear very well. But so some of you have heard the valuation talk before, others have not. The purpose of the talk today is just for the community to understand, who's listening, to understand what valuation means in the context of raising capital, right? My background, prior to joining Venture First, I was Senior Vice President of a company called Valuation Research Corporation, where basically all we did was a boutique valuation firm, primarily for mergers and acquisitions, and also for some capital raising purposes. Those of you who have had the pleasure of raising capital, equity capital in the past, has probably had, and issuing stock to employees, have probably had to have a 409A valuation done. Well, I used to do that at VRC, and we do it now at Venture First very often. Actually, that's a huge piece of our valuation practice. What we often find when people call and ask for a 409A valuation is, hey, I'm about to raise a price round meaning a round that has a valuation attached to it, or a price per share. Can you let me know what the market's looking at? If it's a bigger round, sometimes they'll ask us to put a little bit of a deck together and really do some more deep diving in terms of what we're seeing in the market and how their cash flows relate to valuation. So valuation is something that's near and dear to my heart. I think all founders, bankers, anyone, frankly, that's doing anything in terms of business really needs to understand the basics of valuation because it drives decision making. It's a very high level, pie in the sky number, but it does drive decision making and direction on where you want to take things. I know for my CFO clients, I'm constantly in the weeds in terms of, okay, what do your cash flows look like? What is your revenue coming in? What does your product cycle look like? But because my background is in valuation, and that's really where I started, I'm constantly thinking about, okay, how will this affect the multiple? How will this affect the valuation from a third party perspective? So it's really important to understand that. And so we're going to get started here to basically, first I'm going to start talking about the life cycle of a high growth company, and most of the valuation talk I'm going to focus on today and this afternoon, and we have about an hour, is going to be on high growth, either venture backed or investment type backed companies. The reason why we're doing that is just because that's most of I guess the group that really wants to see what types of valuations they're doing, look at cap tables. It's a little different nuance for cash flowing lifestyle business, but the basics are the same, right? So we're going to go through first high growth lifestyle state or high growth companies, but also you could use this for some lifestyle stage companies if you have a cash flowing business, and I'll let you guys know when that is. Okay, so real quick. The difference between lifestyle and high growth, obviously, is that there's different stages in the life cycle in terms of capital raising and equity raising, right? So this presentation here, or this slide here, shows you, and I wrote it down because because my handwriting tends to be a little atrocious sometimes. But this presentation or this slide shows you the life cycle of a typical high growth company, right? And I separate it by round, investor, milestone, amount, ROI. So for a company that's early stage, right, you're raising a round. Typically, you don't have a product yet. You want to develop your MVP. You have a business plan. You have a seed round. Who's investing in that seed round? Typically, it's your Aunt Betty, right? It's your neighbor that lives down the street. It's your college buddy that has some money that they'd like to spend, and they're giving you the money. So it's friends and family round. You usually have a business plan, but you don't really have a product. You're probably raising about $100,000, $200,000. A lot of software-based, if it's a biotech company, you're probably raising a lot more. Software-type companies typically raising between $100,000 to $200,000 during this round, and it's basically development costs, right? that's what that is. And then the ROI, that's return on investment, right? That's, most people know that. The ROI is basically how much money those people really want to get from putting in $1 of your company, right? If I have $1 and I put it in someone's company for an investment, I have so many places to put that $1, right? I could put it in the bank and I could get, 2% interest right now. I could put it in the stock market, and gets a little tricky now, and we could talk about public equities, but returns are astronomical at that point. But in reality, long-term stock market investment, you're probably going to net over time probably about, 5 to 10% return. I could put it in high-tech bio-growth public companies, and that's probably going to be, 15 to 20% return. But when I'm investing in a seed company that I have no idea if it's even going to, live the next day, I'm probably going to want a lot more return on investment. So I'll probably want 20 times my money back. Then the next stage of a company, if you don't have revenue yet, is a convertible note, and that's when you're raising an instrument called Convertible Note. And that instrument basically is a debt option that will convert into equity when you get a valuation of your company for a priced round. Typically, you're getting into angel investing. Typically, you have an MVP and you like it and it works, but you don't really have a lot of revenue, and you're really early stage there. You're so early, in fact, that we can't really give you a valuation per se. So the higher ups or the people smarter than us both developed this term called a convertible note, which is basically a loan that converts to equity, so I don't have to pay that cash. Those investors, and this always changes with the market, right? But those investors maybe would like 15 times their money back over time. And then the Series A, Series B, as you grow with your company, you're getting longer, you're learning more about your company, you're getting more developed products, you're learning about your customers, you have customers. And so as you grow with your company, you need more money to put back into your company. That's the amount that you're investing. And then as your risk goes down, your risk metric goes down, the return metric, the return that people are expecting it goes down. When I was doing valuations for acquisitions, and I worked a lot with private equity firms would be here. They're right around exit time, right? Their term to exit, and this was 2-3 years ago, was probably about, 4 to 5 years. So when they raise money, so people put them in, they tell them that they will be able to get their money back within 4 to 5 years time, right? So that's what's in their head, private equity firms. And because it's a shorter amount of time, the seed person's probably 10, 12 years before they get their money back, right? And these guys are probably about, they would like 4 years. Anymore these days, it's probably, 4 to 6 years before they get their mony back. So the time to get money back goes down as your life cycle continues on. And then you exit. And then we're all happy because we're making millions of dollars. In terms of that, I wanted to talk about what that means for valuation, right? So when we think about valuation, the basic crux of valuation in Finance 101, folks, is time, right? Time value of money and risk. So the more time, the more risk. And the more risk, we could argue has more value potential or less value potential, right? So return, risk is one and the same in terms of finance and valuation. And I'll show you why, right? So I always say this example, and this is the basic, you could use it for lifestyle companies, any type company, but the basic valuation thought process is, let's look at your cash flows each year, right? And this is called an income approach to value. Let's look at the cash flows each year, and then let's present value them back to today's dollar. And that's going to be the crux of what we're going to talk about today and how we determine certain types of valuation. So let's say if we're looking at an individual, a person for an insurance company, and we want to determine how much to pay out for somebody, losing their job and not being able to work anymore, right? What we would do is we would estimate how much money they would make each year. So let's say a person first year would make $60,000. The next year, let's say their salary increases and they make $75,000. And then the next year, let's say they lose their job or they're starting a new company and they don't have any revenue or any earnings coming in. And then the fourth year, let's say, something happens, we exit, or let's say we're at $100,000 a year we're making. And this is for an individual. This works for a company, right? This works for basically any type of valuation you're doing. It's all about the cash flow. Cash flow is coming in, time, money going out. So then what we would do here to value a certain individual or value anything that has cash coming in with this type of cash flow scenario is this is in time 1, time 2, time 3, time 4, or year 1, 2, 3, 4. We're going to put that back to today's dollars. Time 0 is today. And how do we do that, right? Because if we were going to say, if this is an individual, oh my goodness, the individual is worth, based on what we're looking at here, if we just add these up, right, we're at 235. That's not the case, because that 235 happens over time. Remember, we're looking at a point in time, which is today. So we have to bring that back to today's dollars. And the way we do that, right, is look at risk or look at return. So let's say in time 4, let's say that $100,000 that I'm expected to make in my salary 4 years from now, right? What does that look like in terms of today's dollars, right? Well, you have inflation. You have risk-free rate. You have some risk associated to it. You have risk that maybe I get fired and it doesn't work out, so maybe that's 0. And you have some return. Maybe I make double. Who knows, right? We have to calculate that in terms of valuing a company or valuing an individual. So the way we would do that is to bring it back to today's dollars. Again, Finance 101. I apologize if this is a lot of numbers. You take $100,000 times 4, and you divide it by 1 plus, let's say the return metric is, I don't know, like 10%. So there's 10% risk that I'm not going to make that $100,000 in year 4. And then you take it to the 4th power. You do that for each year, okay? And then you sum up this calculation for each year, you sum it up, and that gets you to the value of a person or an individual today. And then you go out to the market and you say, this is how much I'm worth. Or if you're an insurance company, you say, okay, I'm going to pay you out that much money because that's the cost, or that's the value that you were worth if you were to work that much. So that's basically the crux of valuation. I always say everything about valuation, it's all about time and risk. And always look on a number line in terms of how money is coming in and how risky that money is each year. Another thing I wanted to talk about as we go into this, now we have the basics of valuation and how we always think about value. But for a high growth company, there's different forms of valuation terms. And so, and if anyone has any questions, just we could pause until the end. I'll leave a few minutes at the end to talk about those questions and ask any questions you may have. But let's say for a high growth company that's raising capital, and we want to know what the valuation is. There's 2 key terms here that oftentimes founders get confused on. And honestly, when you have a lot of different types of equity and convertible notes, it's so easy to get confused on, right? But it's pre-money valuation and post-money valuation. Pre-money valuation, as we all know, is money before something happens, right? What is pre? Before what money? Well, it's money that new money is coming in. Post-money valuation is the value of your company post new money coming in. So let's say if I am a founder of a company and I'm about to get in $1 million. I'm raising some sort of Series A equity round, and I'm going out to the market. The value of my company pre that $1 million is $4 million. The value of it after is $5 million. It's really simple. So, but the problem with this is it gets a little muddy, right? So let's say if we have a house. I always say we're buying a house, right? We would never pay post money for that house. If I'm buying a house and I'm looking at this house and it's $100,000, And I go into it and I'm like, okay, I have to put about $50,000 into this or $20,000 into this kitchen. I would never buy that house for $120,000, right? Because that's the money I have to pay to put into it. The value of the house after I put it in may be worth $120,000. Value before is not. When we're looking at companies, especially for acquisition, especially for equity financing purposes, it gets extremely confusing. And the reason why it does get confusing is because where does that end, right? So when I was working with, I remember this so clearly. I was working with a large public company at multi-billion dollars, and they would make a lot of acquisitions. When they made one acquisition, and the value of the company that they acquired was $230 million. So we're valuing the business, and they give me the cash flows. Remember, we're going back to the cash flows. What are your cash flows each period for the company? And then we have to present value it to confirm that $230 million was at fair value. And they gave me the cash flows. And they said, okay, well, here's all the cash flows, and here's all these synergies that we're going to be expecting from these cash flows. Okay, well, what are those synergies? Well, we have to buy a new piece of equipment. We have to hire some people. Our marketing team is going to leverage, or their team is going to leverage our marketing team in order to build their existing portfolio products. So what we were hearing was those cash flows they were giving us were really inflated for all of the stuff that the buyer was putting into the company. So in reality, when we had to back that out, right, because they were looking at it on a post-money perspective, right? The value of the company is $230 million. Well, wait a second. It's your marketing team that's marketing those products. It's your money that you have to spend money on to buy that equipment. So really, that's not the value of the company you bought. And so what we ended up having to do was redo the cash flows. Again, it's a public company, so they would eventually have charges. So to redo the cash flows, and what we found was the business that they actually acquired was not worth $230 million. It was really worth, I think it was like $170 million, right? So they had a $60 million differential between pre-money and post-money. And the only reason why is because they were including all this investment dollars they had to put in to the company to value the company. It happens often. With high growth companies, the way investors do it is they interchange pre and post money, where you have a company and they say, we are going to invest in your company based on a $10 million valuation. Okay, fine, great. What does that mean? That means, and they will never say pre and post money. They'll say, we'll invest in your company based on a $10 million valuation. And then the term sheet will say, and that also includes conversion of all your notes. That includes putting an options pool together. That includes, whatever else. Well, what they're saying is, we're going to invest in your company at a $10 million post-money valuation. When they say we invest at $10 million, and they could even say $10 million pre-money, however, we assume that all of your notes are going to convert to equity. We assume you're going to have a 15% options pool. What they're really saying is the value of your company is not $10 million pre-money, it's $10 million post-money. And if they're going to put in $2 million or whatever, or $1 million, the pre-money valuation is not 10 million, it's 8 or 9 million. So I think it's important to understand that it's not just a simple, hey, pre-money is before investment, post-money is after investment, because it really, it does muddy the waters a little bit, and there's different terms around it. So I'm happy to talk about how we can navigate that. Most important that I always tell my clients is we got to look at the cap table. We got to pro forma that cap table out. That's really how you're able to say, okay, what is the effective pre-money valuation? Okay, but it's also important too because it gives you an idea of value. If they don't tell you what value it is, let's say, for instance, we want to invest. Let's say I'm a founder and I say I need money. I need $1 million and I'm willing to give up 20% of my company. Okay, what does that mean? So as an investor, you basically just told me what your valuation is, right? So if I'm looking for $1 million, right? and then I am dividing that by, I don't know, 20%. So you're going to get 20% of my company. 20% of my company. That means that it is a $5 million valuation, right? But the key to that is it's not $5 million pre-money, it's $5 million post-money. So you have to subtract out the $1 million to get to a $4 million pre-money valuation. So when you talk to investors and you're raising capital and you're talking about how much money you need, oftentimes when you're saying I'm raising $1 million at 20%, that means that what you're saying is the pre-money valuation of your company is $4 million, post-money is $5 million. So we really have to think about what you're saying to investors to just make sure it makes sense. Let's talk about cap table, because when I say pre-money, post-money is very confusing. Before we go into the different ways of valuation, I think it's also really important to understand your cap table, not only present, but also pro forma is what I call it, because then we really get a feel for what this valuation is going to do to your return metrics and your investor return metrics. So my next slide here, I start off pretty simple with a basic cap table. Common stock and stock options, let's say you have 1 million shares on your cap table right now. Let's say you're trying to rate, and again, everything adds to 100 or 1 as a pie. You're raising 500, you raised $500,000 on a convertible note, which we could talk about. And then you're also raising $1 million of a preferred priced round, right, at 20%. So we talked about what that means in terms of pre-money. Pre-money is $1 million is what you're raising. You're giving up 20% of that company, of your company. So that means your post-money is 5, and then your pre-money is 4 million. To get a per share value, that's 4 million divided by 1 million. That's $4 a share. Okay, that helps you understand what you are at a per share basis for preferred. Those of you who had to have a valuation of a 49A know that that price then goes in to do some sort of waterfall analysis on the common stock. Just a tidbit to note, just because of valuation so much, your preferred stock for 49A purposes or options pricing purposes, I see it all the time, the value of your preferred stock does not equal the value of your common stock. I see that all the time. When somebody is issuing stock options, it does not equal. So if I'm telling you the value of your preferred stock is $4, please don't put that into your stock option agreement and saying that you're granting common stock to your employees or whomever for $4, because it's out of the money. They'll never get the money back. But that's another topic for another day. But you just know that preferred stock value does not equal the common stock value. So going back to the cap table, we're raising $1 million of preferred. We've already raised $500,000 of a convertible note. I'm going to show you how this cap table, all of a sudden, with 90% owner to common, let's just say that's the founder, 10% to stock options. I'm going to show you how diluted you could get. All we did so far was raise $1 million, and to our notice, we're only giving away 20%. But in reality, it's going to be a lot more, and I'll show you how. So the next slide here shows you exactly what we did. So what happens here is, going back to the other slides, we had $4 a share of a preferred stock, right? So that's $4 a share. Remember, we raised $500,000 on a convertible note. A convertible note is interesting because it converts to equity, but it usually doesn't convert to equity 1-for-1, right? It usually converts at a 20% discount, or a 30% discount, or a 10% discount. So if I'm raising at a $4 per share preferred valuation, $4 per share, my convertible note terms typically have a 20% discount. It's a sale price, right? Hey, I'm coming in when your company's less risky, so I want more return. How are you going to give me more return? You're going to discount the price, right? So what you're going to do is you're going to take $4. Usually it's a 20% discount. I've seen 0, I've seen 10. Usually it's 20. So you're going to take $4 a share. So you're going to multiply it by 1 minus 20% to give you the per share price of the convertible note. Remember, convertible notes are converting into preferred shares. It's the same class of equity, but they just get a sale price, right? Because they bought in earlier. So then that $3.20, you take $500,000 on the convertible note, divide it by 320, and that's how many 156,000 shares is what you're giving to the convertible note because they invested in your company, right? Now your cap table no longer looks like 90%, 10%, right? It looks like common, options, and then these are preferred together. You're giving up, your 90 goes to 64%, your 10 goes to 7, and really you're giving up 29% of your stock. Remember, what we did was we raised $1 million at 20%. And this actually, you could see it's not even 20%, it's 18%. The reason why it's 18% is because, and this is where this post-money, pre-money evaluation comes into play here, it's 18% because they get diluted for the convertible note percentages, right? That's the basic crux of this. So what investors say, if you're a preferred investor, they know this is going to happen with these convertible notes, right? They know this is going to happen if they just do the 1 million at 20%. So what they'll do is they'll say, we'll give you 1 million for 20% of your company. However, we want all those convertible note holders to convert. We want all of them to convert. So then they move here. This goes to 20. What happens is that the founders and the founders get diluted even more. And that's the difference between post-money and pre-money and post-money. And that's why it could get a little confusing. We could talk about this because I know there's a lot to this slide. Basically, that's where the confusion lies in terms of post-money and pre-money. And this is how your dilution happens with convertible note, right? Oftentimes you see dilution and the examples are only just equity. But I think it's important to note that you have to actually look at all these other types of equity or investment vehicles and see how it comes into your cap table. Okay. Actually, let's stop there. Are there any questions so far? Because I know I just dove into this and there was a lot of detail. If you have any questions on the cap table or anything else in terms of time value of money, let me know and we could, or otherwise we could go on. I'm looking to see if I can see a chat. I think we're good.
What are you seeing in our market? Is it a lot of notes early on for just early on startups, or I'm just curious. Like I said, when you see the Louisville and Southeast and Midwest markets compared to the coast, like what are you typically seeing? Is it more notes?
Well, there's notes and there's safes. I'm continuing to see notes. Honestly, I've seen 1 or 2 safes, but more and more it's just notes because it's easier to just put the note in without having evaluation done. Assuming you're at that stage of the company where you're pre-revenue or you're a little early for Series A. When I say you're early for Series A, I'm saying your revenue is less than $1 million. You need less than $2 to $3 million. We're not going to call it an A. Venture capital won't look at you. I'm seeing a lot of notes though. Yeah.
Awesome. Thank you.
Mm-hmm. Another thing I didn't add to these notes is accrued interest. So a lot of the times you have to, and I don't know why convertible notes are so popular because they are a bear to manage, but you have to calculate your accrued interest each quarter or each period, and then that gets added to this price. So if my accrued interest is $30,000, I only invested $500,000, but I'm converting $530,000 at a $320 price. You're going to get much more dilution here, right? So. Yeah. Yeah, Jane just said they are tough to come by around here. I've seen one or two. It's tough. Safes were popular for a hot second, I think, but then it's just hard to get people to fathom what's happening because you're not really getting any interest. You're not really on the balance sheet yet. What are you? Are you debt? Are you equity? I don't have any piece of paper that says I'm anything, or at least with a convertible note, you have a note, and if something falls through, you still have that, you know, hey, I'm going to get paid back somehow or another, right? Yeah, I just got done with doing working on a cap table for a client that actually was raising, I think 5 or 6 different convertible notes over 5 or 6 years that had different tranched interest rates, that had different cap values and discounts. The cap table was atrocious, and it was all in these convertible notes. Hopefully we cleaned it up.
From an entrepreneur's perspective, not the investors, what is more favorable and why? And maybe it's different situational where you'd want a convertible note versus a safe, but when should you look for which one?
I personally like safes for founders because I personally do, just because they seem simpler and you're not getting that interest hit, right? You're not getting this interest hit. I mean, but at the stage that you're in, you know, I think it's whatever your investor feels comfortable with. I would be happy starting with a safe to see if people are interested in it. If not, then go to convertible note. Another thing to think about as well here is that a lot of the times that these early stage companies, most of them start out as LLCs, right? So it's a little harder to do a safe with an LLC, in my experience, just because you don't have stock, you have units. So it sort of lends itself to a convertible note. And just for accounting purposes, a safe is considered equity. On your balance sheet, a safe is considered, you know, equity, and then the convertible note is considered debt until it converts. So on the balance sheet, it looks a little, it's placed in different buckets. What are you guys seeing? Are you guys seeing any issues with safes and convertible notes around what you're looking at? All right. So we can get started. Oh, I'm hearing this static. Yeah, I agree. Lots of risk aversion. They just don't know what they don't know here, right? So they're gonna go to the convertible notes.
James says lots of risk averse capital in this area. Convertible note is the preferred pre-seed mechanism.
Yep, absolutely. So I want to get into the nuances of the valuation talk. So for early stage company, I always separate them between revenue companies and non-revenue generating companies. So pre-revenue, post-revenue companies. This first method of valuing a company is, and when I say valuing a company, there's multiple ways to value companies on different sides of the fence, right? So I could talk about the founder way of valuing a company, which is, you know, I'm going to be $1 billion, so why can't I raise $1 billion? No. But in terms of the investor side of looking at a company, founders have to think about this, right? And I say this to all of my clients. Oh, you want to raise on a $50 million valuation? Okay, great. You have $1 million in revenue. So take 50 million divided by 1 million, you're 50 times revenue, multiple company. Show me where you get 50 times at any stage of a company's life cycle, and show me a market transaction that shows that, right? Because that's how we always think about it. So that's the market approach. This essentially, what I'm showing you in this slide is essentially a market approach, just a more detailed market approach for companies that don't have revenue, right? So I can't say, oh, I have $1 million of revenue, I want to raise on a $50 million valuation, that's a 50 times multiple. I can't do that. So what I have to do is I have to look at the market from a different perspective. And usually when you're looking at a market approach, we usually look at it for cash flowing businesses. I always looked at it for different perspectives, right? Is it in the same industry? Is it in the same life cycle or stage of the company? And for early stage companies, it's important. And I think we touched upon it already, is where are you in terms of your geography, right? Because people in Silicon Valley, and that's just a whole different animal altogether, companies in Silicon Valley, they could raise on different multiples, and I would argue anywhere else. Well, Boston could probably raise, and Silicon Valley could probably raise at the same multiples or the same valuation metrics, then I would say everyone else, right? You have some New Yorks and Miamis and Chicago's that may in between, or in Austin, but mostly not. So this method of valuation is the valuation that we use. I'm going to refer to it as a market approach. Well, we're basically, if I am an investor and I want to invest, and I'm an angel group and I want to invest in this company that has zero revenue right now, how am I going to do that? I'm going to look at factors of the business, right? If I am an investor and I am part of an angel group, I am looking at not one or two companies, right? But I'm looking at 50 or 60 companies a year. So I have an idea of what is out there in the market. So I could compare what I see when I see a pitch deck, when I'm doing due diligence, I'm comparing with everyone else, right? I'm the dealer. And I think founders have to understand that, right? So you could tell me till you're blue in the face that your company is worth $10 million for a pre-revenue stage company. I know what's out there because I talk to other investors. I have insight into the market. And we've done deals before, so we know what's going on in the market, right? And we also have investors that we have to answer to, so we can't be like writing checks for very high valuation companies, right? So this approach I'm showing you is the scorecard approach. This scorecard approach, and I encourage founders to look at this because this forces you into thinking about due diligence in a perspective that an angel group or an investor would look at it. So what it does is it gives you, I think, 6 or 7, what is it? I think I have 7 here, 7 qualifications that a company should have, right? And it compares it to what is in the market. Well, what is in the market? Well, I look at Crunchbase. There's different database sources. I, listen to or I read articles on the market. I talk to other investors in my area. I see all the other companies that are coming to pitch to us. That's my market, right? So larger companies, cash flow companies, their market is public stock. So their market is really easily to see. People are transacting all the time, right? But for these smaller companies, the limited perspective I have is really based on what I know at this location or in the demographic, right? So the major qualifications are, and this is important for founders to know, management team. The earlier stage company you are, the more important your management team is. I don't care what anyone says, right? That's all you have is your management team. Then we look at your business plan. Does it make sense? Am I selling, oil, right, to Tesla or, electric car vehicles? No, that's a horrible business plan. Why would I do that? And again, I don't know too much about it, but the other day somebody came up to me and asked if we'd like to help capital raise for a pipeline company. They were having a hard time raising capital down in Texas. And I was like, I don't know much about it, but I have a feeling I know why they're having issues. Anyways, what's their business plan? Product, technology, does it make sense? Is it viable? We know it's constantly going to change. There's constantly pivots, right? Market size, competition, sales channel, and then whether you need more investment. As an investor, I'm going to look at these when I do my scorecard method. I'm going to jot them down, and every different investment group has different weights or different importances on each of these. Early stage companies, I've seen this as high as 50%, 40%, everything has to tie, but basically the importance of management here, I'm going to weight that 30%. Business plan is actually pretty important here. That's 20%. Product technology, the earlier the stage company you are, I would say maybe the less importance it is, because as long as you have the basics, right? You have the product, you have a technology understanding, your management team is like kick ass, and they're able to quickly pivot, and they're able to, okay, this is my viable business plan, and I could pivot my tech and product. Maybe this is less important, so maybe this is 15%. Your market size, depending on who you're talking to. Some venture capital firms, right? If you're going to go out for venture capital, they say we'll only invest in market sizes that are greater than $1 billion. It's just the way it is, right? They have return metrics to hit. That's what they're going to do. So that's your market size. Competition, how many people are you competing with? Sales channel, how are you getting to the people you're selling to? I will say for this one, your sales channel founders, if you have dual sales channels, i.e. a lot of the best example of dual sales channel is when, let's say you're a recruiting firm, your one customer that you have to recruit to are the employers. You have to get them on a platform, and then you're also recruiting to people looking for workforce. It's dual sale. You're selling to do different channels. It's a little difficult to do. So that's an example of that. More investment. Do you need more investment? How much more investment? That's key, especially if you're an angel group, because you're going to get diluted, right? Angel group, or the earlier stage you are, expect to be diluted. We just saw the cap table before, founders got diluted almost immediately, 36%, right? Just by that first round of raising $1 million at a $20 million equity or valuation, or 20% hit, they got diluted 36%. That's going to happen. So the more dilution, the more that's important. Anyways, and then you multiply all that weight by a factor. The factor is how I rate you. What's your scorecard? What's your report card say? If I know that a management team that I'm looking at to start a company, I have 2 founders, both of them had multiple exits, both of them know the industry really, really well. If they're trying to start a company in esports, and however most of their experience has been in accounting, I'm going to say, okay, really. But if they've had a lot of exits, they know how to build companies, we're going to see that. So we have a really good management team. I'm going to put and the factors here range from I'd say 0 to 2, something like that. So I have a really good management team above the average of what I'm seeing in the market. I'm going to put that factor higher. I'm going to give them a higher report or higher grade, and that's going to be 1.5. And then all you do here is you multiply that and you go down the list, right? When an investor is doing due diligence on a founder and they're asking for information, most likely they're looking at these factors for their due diligence list, and they're asking you for information, and they're really doing this. Okay, so it's important for you guys to understand that. And then you multiply that and you get your score for each factor. You sum that together, and then that's your total score of your company, right? Let's say this company, the score is 1.2. What does that mean? That means nothing. It's just a factor. You multiply it by, again, we're looking at the market. You multiply it by where the market has transacted recently in your company, in your life cycle company, life stage company, in your demographic area. So let's say we're in the Midwest. Typically, companies in the Midwest that are raising their first round or raising some sort of priced round, that they're pre-Series A, I'd say typically their valuation is between like $2 and $4 million, right? I've seen as low as $1.5 million. Okay. If we're in Silicon Valley and we're pre-revenue, we're pre-Series A, but we're raising a priced round, I would say that their valuations are anywhere between like $5 to $7 million. So it's very important to understand where you are. And this is also key, because I am also an investor. A lot of Midwest folks see the prices of the Silicon Valley and the West Coast companies, and they're like, whoa, this is too expensive for me, right? I mean, $5 to $7 million, I could go look and see a company here within the Midwest, and they're going to the market at $2 to $4 million, right? So it's hard for Midwest people to see those high valuations. And on the flip side, a lot of those people on the coast see Midwest valuations are like, oh my gosh, this is so cheap. Let's start getting in here, because they think we could get into the Midwest at lower valuations. We could invest some capital within these companies, and then all of a sudden, we have a very high valued company. It just takes long to do that, right? So that's where we are. So let's say this company is, or in this market, and it's pretty standard. Let's say it's $2 million is the valuation in the market. And you could find that out anywhere. There's articles that show you, where valuations are falling for high growth companies in different regions. Like Crunchbase has a pretty good database of that. So then you multiply that together, right? And then that gives you the value of your company, right? So if we're at $2 million, 1.2, so that's what, $2.4 million. So as a founder, you did all this analysis, or as an investor, you're doing this analysis on a company, you're coming up with a $2.4 million valuation. And if you're raising $1 million at a $2.4 million valuation, that's pre-money, you're going to say, okay, this is how much percentage I want of your company. Okay, so this is the scorecard method. And I put some notes here. Actually, here it is. So pre-revenue size companies, 2 to 4 million is typically what people are raising on. 5 to 7 million for San Francisco. 2.2 million has 1.2, gives you a $2.4 million average company or average valuation. Okay, so let's take it a step further. If you're raising $1 million at a $2.4 million valuation, your post money is 3.4 million. So that means that investor wants, 1 divided by 3.4 million. So they would want 29% of your company. Okay. Typically for earlier stage pre-revenue, this percentage is probably between like 35% to 45%. 40 seems high, but they're going to start at 40. Probably most likely going to be around the 29 to 35% range of equity giving up. But this is how you support evaluation. Okay, that's the scorecard method. The second method I'm going to discuss is the venture capital method. And that method is all about returns. Okay, and we have a few more minutes left, so we'll go through this real quick. So the venture capital method is it's a straight up formula, right? Basically, the value of your company, remember this, the valuation is your exit, is your terminal value divided by your return on investment. That is what the venture capital method is, okay? So value equals terminal value divided by your ROI. Let's say I exit my company for $100 million, okay? That's the terminal value. That's what we're going to start with, your terminal value, okay? I'm going to go through a quick example here. In this example, my terminal value, what I exited at, was $50 million, okay? Let's say that if I exited at $50 million, or let's say the way you start with this is, let's say in 10 years or in 5 years or whatever, I know you do your monthly forecast, and I know that my revenue is going to be $25 million in year 10. Okay, I know in the market that $25 million, the industries that are in my same industry, they exit for 2 times revenue. Okay, so what I'm going to do to get to this terminal value is I'm going to say $25 million is the revenue multiple for my company in 10 years times 2 times revenue multiple. That's, you can find that in the market. What an industry multiple, that gives you a terminal value of $50 million. That's great. That's in year 10. We have to bring that back to today's value. Remember that? So then what we do, actually it's 50 million times 2. That's my example. So it's 100 million. So let's bring it back to today's value, right? So let's say my exit value is 100 million. I said 50 or here. It should be 100. And let's say my return on investment is 20 times. So I give you $1. I want $20 back in 10 years. Okay. So that is 20. So that means that you take $100 million, which is the value of my company in 10 years, divide it by how much return I expect, and you get your value of your company, which is $5 million. However, that is post money. You have to subtract out the investment dollars that you want to bring to the table, and that gives you your $1 million pre-money valuation. How did we get to 20 times? That's like what everyone thinks about. Like, how did I even get to a 20 times ROI? Well, remember, and again, you could find this in the market, and I'll go back to it before, is right here, your ROI. Depending on when you invest in a company, you expect to receive a certain return on investment. And that's basically what is used for the venture capital method to determine what the value of your company is today. And all that really is, that 20 times, is basically this calculation here. It's this bottom calculation. It's what your risk is over time. Know that for earlier stage, you want more return on revenue. Later stage, you don't want as much return on revenue. Okay. And so in this example, I just go through some more debt and equity questions, and I know we have 4 more minutes left. So if we have any questions, I ran through the venture capital method real quick, but if you have any questions, let me know. It's pretty straightforward, but it's also very important to understand. This is where the VCs really look at what their value is. How do you value terminal value? Well, you look at revenue, you look at how big the market's going to be. You look at what the market multiples are in the industry. How do you value ROI? Well, what's the risk on that company? How long are you planning to hold the investment? What's your return metrics? As a venture capital firm, I told my investors, because I have investors, that I'm going to get them 4 times their money back. Well, how am I going to do that, right? And so that's basically what that number is, right? It's basically the return that investors are expected to get from your company. And we could talk about this all day. There's so many nuances to it. But if anyone has any questions, I could stick around for about 5 more minutes.
Yeah, that was wonderful, Daniela. Thank you so much. I'm more accustomed to the industry multiplier, but for those that are not familiar with that, what would be the best resource to be able to find industry multipliers?
I always look, so industry multipliers, good PitchBook has good data around it. Just Google what people are expected to get on returns. I look at S&P Capital IQ has information on it. So there's multitudes of resources out there. So I would say Crunchbase, PitchBook, just search, Google search, return metrics for different industries, and you'll be able to find tons of information on it.
Thank you. And then I've never seen that scorecard method before. Is that more for an individual investor, or like an angel, or what round who would be using that?
I would use it for what you never see it you would never see it explicitly stated, but basically it's always the crux of, and I'm part of an angel group called Next Wave Ventures, and we invest in females run high growth businesses, and we use that as part of our methods when we're doing due diligence. So we're not explicitly stating, okay, here's where it is. We're using it as, hey, does this valuation look right type of thing? Did we make sure we looked at all of the qualifications that make this company successful and looked at it? That's basically what we're doing in the background. We're just not really stating that's what it is.
What other questions do we have for Daniela? Feel free to unmute yourself.
Sometimes I go into how to get to the return, like not only just like a multiplier, but also like stepping it a little bit further, right? When you have 1 divided by 1 plus X over whatever time. Let's say you're a venture capital firm, you're expected to hold your shares, 10 times. What does this percentage have to be to get to a 20 times return, right? And so that's basically the key to the venture capital method, is understanding, and this is risk, understanding risk.
Well, awesome. If there's no other questions, I'll go ahead and hit stop on the recording.